Hello, everyone. Welcome to a Wall Street from Main Street podcast. My name is Mo Dawood, and today's guest is Tim Iacono. He's the founder of Iacono Research, and he's also editor of the blog, The Mess That Greenspan Made. Tim, thank you for joining us.
Well, thanks for having me on.
So I want to start off this podcast by talking about your blog. You started a blog and it's dedicated on focusing on the monetary policy that Alan Greenspan made when he was the Federal Reserve Chairman. So let's talk about that. After the dot-com bubble, the central planners decided to start another bubble, and it was a housing bubble. And one of the ways they've done that is they slashed interest rates, and that causes a expansion of credit and the money supply. So let's talk about Alan Greenspan and his role for the housing bubble. So how much blame should he get for what happened in the housing bubble?
Well, I think he was largely responsible. Not so much. Low interest rates were certainly a factor, but it was the lack of any sort of regulation. Low interest rates in and of themselves are not that harmful, but when you basically just look the other way and let an entire industry go wild, as was the case with the mortgage industry and the credit derivative industry back in 2003, 4, 5, and 6, then you're kind of asking for trouble. And the Federal Reserve is the nation's most powerful regulator, if for no other reason that they have a big bully pulpit in the financial industry, that if they say they're going to crack down on mortgage lending, for example, then that affects behavior in that industry. So I think over the years, Barry Ritholtz had his book Bailout Nation, which chronicles the history of bailouts, most of which were under the Greenspan Fed. That's a really good summary of Alan Greenspan's tenure at the Fed, which was basically one bailout after another. And what's interesting this time around is that after the internet bubble burst, there's an impression in the Fed that they can just clean up after burst bubbles, and so that's what they did with the internet stock bubble, and then they inflated the housing bubble, and that led to the financial crisis in 2008. And so the theory that they can just clean up after bubbles has been largely discredited, although, in fact, I should say clean up after bubbles by inflating new bubbles. I think that's been discredited, but you look in Washington, and that's exactly what they're doing again this time around. You have pretty good bubbles going in junk bonds and some equity markets, and even in housing. Some Robert Shiller of Case-Shiller Home Price Index just a week or two ago was talking about how some areas that were once housing bubble hotspots in the West and the South are looking pretty bubbly again. So I think Greenspan pretty much set the tone for what Bernanke did, and now we have Janet Yellen, who's nominated to be the new Fed chair, and she'll probably continue that policy. How it's all going to end, I don't know, but you have to think that some people at the Fed are really scratching their heads now, since we're about 5 years past this last recession, and things are fundamentally different at this point in the recovery than they were during previous recessions.
And one of the major things that happened under Greenspan is that the banks got bigger and bigger under Greenspan as well. Since they got rid of the Glass-Steagall Act, we've seen banks like Goldman Sachs and Bank of America and all the other banks just control a lot of the assets, not in just this country, but all around the world as well. So that's one of the main things that I remember from Greenspan, is that the way they let the bank just get bigger and bigger without much competition, and very high barrier to entry as well.
I think if you recall, it was back in, I think, 2009 that Greenspan was called to testify before, I think it's called the Financial Crisis Inquiry Commission. And the thinking that he had operated under for many, many years was that banks would regulate themselves. Now, you have this growing size of banks, which has gotten even worse since the financial crisis. That's a huge problem that no one in Washington is dealing with. But then you have banking regulation that Alan Greenspan really thought that banks would regulate themselves. They would not do things that would be, in their own worst interest, meaning they wouldn't go after short-term gains that have undue risk. And that's exactly what they did. Another, I think, important part of the Greenspan tenure at the Fed that led up to the crisis that Bernanke oversaw when he came in was that the shadow banking system, as they call it, grew to be, in many cases, some areas larger than the commercial banking system. Now, this was entirely unregulated, yet Alan Greenspan would go before Congress in 2004 and 5, and you'd have people asking him whether he's concerned about the banking industry and asset bubbles, and he would say that all of the metrics that they used to measure instability or potential crises in the commercial banking system indicate that there's no problems. And a large part of the problem, primarily the source of the problems back in 2007 and 8, was this shadow banking system that had completely run outside of any sort of regulator. Yet, Greenspan was able to say, yeah, the banking system is sound. Well, that's not where the crisis originated. It was in the shadow banking system.
And I find it interesting that ever since he left the Federal Reserve chairman, everything he said is kind of the opposite of what he's done. So I see him do public speaking, and he's talking about the gold standard and concerned with inflation and et cetera, and Bernanke should be doing this and that, and I never seen him do any of that when he was a Federal Reserve chairman either. So it's kind of odd to see how he completely went opposite after he left as Federal Reserve chairman.
Yeah, he spoke fairly candidly a year or two after he was out, and lately he's been critical of rising budget deficits and debt, and I think perhaps the most important legacy of his is that lack of regulation that I was talking about, and he has commented on that I think he should have done a better job at that, but he let that system basically run on its own for 18 years, and it doesn't really matter what he says now that someone else is dealing with those problems. But the worst part about it is that they're dealing with the problems in a way that will only make bigger problems down the road. And that's a good example of that is what you mentioned just a short time ago, how the too big to fail banks are getting even bigger than they were back when we had the crisis in 2007 and 2008.
Now let's shift gears here and talk about Ben Bernanke. He pretty much continued what Alan Greenspan done, created a boom and busting economy. We had after the housing bubble, we started another bubble in the stock market right now, also in the bond market, and there's a small mini bubble going on again in the housing bubble as well. And now as he wrap up as the Federal Reserve Chairman, what do you think his legacy will be 50 years from now? Will it be like so similar to what FDR legacy is today, where everybody held him as a hero for getting us out of the Great Depression, even though his policy did make the economy worse?
Well, I think the time period there is all important. You said 50 years. My guess is that 50 years from now, there will be a major rethinking of how economies work and how central banks should operate. I think over the next 5 or 10 years, he'll still be looked back upon as the guy who prevented another Great Depression. But I'm very sympathetic to the views of Austrian economics rather than what we've seen in mainstream economics over the last few decades or so. I think over a period of 50 years, I think Ben Bernanke will be looked back upon as the guy who brought the era of Keynesian economics and uncontrolled central bank intervention. He'll be looked back upon as the guy who brought that to a head in in his actions taken after the financial crisis. What we've seen over the last 4 or 5 years with the money printing and I think there's this conventional wisdom on Wall Street, certainly, that this is just the way the system operates. The Fed is going to continue to print money, and that somehow they're going to they're going to undo all the things they've done over the last 5 years without any serious repercussions. Now, I think, in my view, I think that's highly optimistic and highly unlikely that it will pan out that way. Exactly how it plays out, nobody knows, but I think over the longer time period, I think Ben Bernanke will be looked back upon as the guy who kind of sealed the fate of the current thinking, which Greenspan implemented with money printing and low interest rates. And I think there'll be a major rethinking of how economies and central banks are supposed to work. But over the near term, I think for the next probably 5-10 years, or until we get a collapse that is perhaps worse than what we had in 2008, I think he'll just be looked back upon as the guy who prevented another Great Depression.
And similar to FDR, because everybody look at FDR and they said, "Oh, this guy took us out of the Great Depression." And also, won the World War II for us as well. But even though that some of his fiscal and government policy and regulation just made everything a lot worse during the Great Depression, and that it could have ended earlier than without his policies and regulation, and you just get out of the way and let the free market just take care of the economy and etc. Wouldn't you say?
Well, that's an interesting parallel, because there's before the Federal Reserve really got things going, they were founded in 1913, but they didn't really figure out where all the knobs and controls were at the central bank until the mid-20s. 1921, they had a depression. Before the central bank, they used to have depressions and then expansions. The depressions were short and fast, and then the expansions were pretty robust. So you had one in 1921, and the central bank wasn't up to the task of intervening yet, so they let it run its course. It did so, and the economy bounced back within a year, and things were booming again. Then you had the Roaring '20s. So the difference was after the stock market bubble in 1929, that burst, and that's you don't hear that from contemporary economists, but that was due in large part to the expansion of Fed policy in the 1920s. They took various actions that expanded the financial system was fundamentally different, but they expanded the money supply in the mid-20s, and there was a lot of things going on between the U.S. and the UK with gold and the gold standard. So the Fed really laid the groundwork for that bubble and bust, and then by the time the Depression came around, the Fed was intervening, the government was intervening, and the U.S. economy didn't really recover until World War II. The Great Depression was really two terrible depressions, 1930 to 33 or 34, and then again in 37 and 38, I believe. But the U.S. economy didn't really pull out of that until World War II heated up, and then we were standing on the sidelines, and we had this military industrial complex that was just heating up. Exports boomed. Everyone went back to work, and the economy boomed. So that's, in the late 1930s, the World War II is really what brought us out of that depression. So you think about the recent recession being parallel to the 1930s Great Depression, but it being fundamentally different. I don't know, because of the way monetary policy is conducted, I don't know what's going to pull us out of this. A lot of people call this a depression. It would certainly be a depression if the Fed had not intervened as they have. So I'm not sure what's going to pull us out of this depression, if there is something that is going to pull us out of it back to a period of stronger growth. But I think there will certainly be a lot more, as each year goes by, where the U.S. economy performs very poorly, which is what you've seen for, 5 years now, which is basically unprecedented. to have this poor a recovery after so many years. With each year that goes by, I think you'll have more and more economists and policymakers looking at the comparison between the 1920, 21, 22 recession and the depression in the 1930s, and the extent, the length of those two slowdowns relative to what policymakers did and the central bank did to intervene. I'm of the opinion that it's quite possible that if they had just let things take their natural course, we would have had a terrible 1 or 2 or maybe 3 years. But by now, we would be back into a better growth with perhaps some real structural reforms in the financial system. But here we are 5 years on from the recession, and there's basically no real hope of any time returning to the growth rates that we're accustomed to. And here we are with the stock market that is 4.5 years into a new cyclical bull market. And I wouldn't be surprised if we have a new recession starting later this year, beginning of next year, and stock market and housing market may reverse course. And then that will really be something for economists and policymakers to scratch their head about, that we had another recession when we never really had a recovery between the 2008 recession and the next one.
And actually, if you look at today's unemployment, which is the real unemployment, so that not the one that the government put out there every month, the real unemployment is around 20 to 23%, which is like Great Depression number right there. I think back in the Great Depression, unemployment was between 20 and 30% throughout the 1930s when they had a Great Depression. I think the reason why it doesn't feel like a depression is because we have all these government social programs like Social Security and disability and unemployment benefits that kind of covered up the bad stuff that's going on in this economy. And we give credit to the government and the Federal Reserve for creating an illusion that everything is fine and nothing wrong with the economy, even though if you dig deeper into the numbers, you actually see that we actually are in kind of a depression. Maybe not as bad as the Great Depression. I mean that's debatable. And then also I wanted to note that if you look at the 1920 depression, which I consider the forgotten depression because it only lasted 18 months, and it only lasted 18 months because the government did not interfere. They let the free market readjust price. Wages went down because we had deflation. Then everything became cheaper. Standard of living increases, and people started to save, and that led us into the Roaring '20s. So I think maybe the economists and the government regulators and the people that make the policy should study the 1920 depression and see what they've done there and try to model their policies from that era. Don't you agree?
I think there will be more. I think modern day economists, they just don't want to hear anything about Austrian economics and free market. The debate between Hayek and Keynes was, I think, settled after World War II as far as modern day economists go. I think as this recovery or new recession goes on year after year, I think you'll have more people looking at the early 1920 Depression and then the Great Depression and looking for parallels to today. And I really do think that you'll have a major rethinking of how economics, how policymakers and economists see the world within maybe not the next few years, but certainly in 10 or 20 years, because any impartial observer who would come and look and see the condition that we're in right now, you look at the mortgage market, for example, and the U.S. government is guaranteeing like more than 90% of all new mortgages, so that the housing market is basically being propped up by the government in combination with the central bank that has these super low interest rates. It's been a lot of Wall Street investors who have benefited from easy money from the Fed to buy homes, there's this huge market in Wall Street firms buying homes to rent out, and a lot of that is due to easy money from the Fed. And you'll have people looking, any impartial observer would look at the condition of things and just realize it for what it is, which is, the economy as we knew it is being propped up by government and the central bank. And I think that's the fundamental difference between Keynes and Hayek, that the involvement of government and letting the free market work, that I think there'll be a real rethinking of how that works as we get further and further into this, very weak recovery and possibly a new recession.
And I agree there. So let's shift gears here and talk about Janet Yellen, which has been nominated as Fed Chairwoman today, actually. I want to get your thoughts on her impact will be on the economy and the stock market. A lot of people out there are calling her more dovish than Bernanke. So should we expect more aggressive QE program to come out when she become the head of the Federal Reserve?
Well, I wouldn't be surprised. She is widely considered to be even more dovish than Ben Bernanke, who was perhaps even more dovish than Alan Greenspan. And I think the key with Yellen is that, and you saw this in the last couple of years under the Bernanke Fed, was that there was much greater emphasis on unemployment rather than consumer prices. So the Fed has a dual mandate, which is stable consumer prices and low unemployment. And in the last couple of years, particularly with the QE3, you saw a real focus on the relationship between Fed money printing and the labor market. So I personally, that was part of the, I think the Humphrey Hawkins Act back in 1971, where the Fed was given this dual mandate to look to try to boost employment, which in itself I think is a fundamentally flawed way to go about it. If, for example, you have a dysfunctional government who doesn't want to do anything to help the economy, is that reason for the Fed to just print crazy amounts of money to try to boost unemployment? I don't think so, and that's basically what's happening right now, is that you have a federal government that is really doing nothing to help the economy. And so the Federal Reserve is basically taking it upon themselves to do whatever they can to boost employment. And right now that consists of $85 billion a month in Fed money printing to buy treasuries and mortgage-backed securities. And with Yellen, I think it's more likely to increase than decrease early in 2014. Nothing's going to happen here in October or December when the Fed meets, and then probably nothing until Yellen takes over in, I think, January 31st of next year. And who knows what the economy will look like then. There's lots of signs that the economy is weakening, that profits are weakening, the housing market is topping, and this move up in interest rates from what are really freakishly low levels earlier in the year, that took mortgage rates from like 3.3% up to over 4%, and took the long-term Treasury yields up significantly. That has had a tremendous impact on the economy. So just talking about tapering has already caused financial markets and the economy to stumble a little bit. So if that continues and Yellen takes over, I would bet that you'll see that number increase from $85 billion rather than taper from that level.
We also had Mark Barber on last week, and he thinks that Yellen will would decrease the interest rate into the negative territory. Do you agree with that prediction?
I don't know. I haven't really given that a whole lot of thought, and I think that that's widely considered to be taboo amongst central bankers around the world. They talk about it a lot, but I'd have a hard time. I guess nothing really surprises you anymore. I'd have a hard time thinking that they would actually do that. But if push comes to shove, that their interest rates are at zero and they're already printing so much money, what else can they do? Well, if they get into a position where they're looking for something else that they can do because the economy is floundering again, I guess I wouldn't be too surprised. If you look back, 5-6 years ago and think about what central bank policy initiatives were back then, and then you fast forward to today, what they're doing today is just so radical as compared to what was considered normal central bank policy for decades and decades that, who's to say what they'll be doing in another year or two.
And I agree with you there. Who knows what they could do? They could also go in and start buying stock in the stock market. They could also go out and start buying the municipal bonds that are out there for, especially in California, that maybe one day might need a bailout just to survive. So, Tim, I'd like to thank you for joining us on Wall Street for Main Street podcast. If people want to find out more about what you do, where can they go?
You can just go to timiacono.com. That's TIMIACONO.com. And I also have an investment website called iaconoresearch.com. Both of those are just search on Iacono, or you can even search on Greenspan, and you'll get to my blog that way.
Okay, great. Well, thank you, Tim, and hopefully you can come back on in the future.
All right. Thank you very much.